what I want to do tonight is I want to answer any questions that you might have with respect to homework number 1. I want to go ahead then and deal with questions you might have coming off of the in-class problem sets. I want to then revisit this issue of valuation or value equals the present value of the discounted cash flow plus the present value of the continuing value and all of its attending parts. Okay? I'm happy to go through and deal with questions about WACC and such if you have them as well, but I prefer not to spend too much time there if we can avoid it. I then want to move into talking about net present value, internal rate of return, payback ratios, modified internal rate of return, profit indexes, which sounds like a lot of stuff, and it's not all that much because you know some of it already, you just don't know that you do. Okay. And we're going to look a little bit at Excel for that. We're going to look a little bit at the calculator for some of that. And then I want to make sure that we look at a multi-columnar approach to thinking about valuations, which is really going to help you as you try to articulate net present value, internal rate of return, etc. And then finally, I want to consider some sources of ROIC and growth. I won't introduce the problem set. Well, I will introduce the problem set for tonight. You have the second half of using CAPM and WACC, and then you have in project investment selection. Okay? And it's the project investment selection that I'll introduce to you tonight. And we're going to do that in a couple of hours and a couple of minutes and be happy about it. Fair enough? Okay. It's actually not nearly as much as it might look like, I promise. But it will be an action-packed 2.5 hours. Okay, so with that, talk to me about some questions you might have had with respect to homework 1.
Just a quick question on the WACC equation. Tell me what V stands for. I understand it's the sum of E plus P plus D. Does V stand for?
Yeah, that's a really good question. So V is simply a variable that equals E, P, and D. You want to, and sometimes I want to do the same thing, make it, I want it to be something else. I want it to be representative elsewhere. It's almost enterprise value, right? In fact, if we subtracted cash from it, it would be enterprise value. But it's not expressly enterprise value. So I guess what you could say is that V, since it equals the value, market or book, I prefer book, or rather market of course, it equals the value of the common stock, E, the value of the preferred stock, P, the value of the debt, capital debt on the balance sheet, D, and all that is equal to V. So I guess you could see or say that it equals the value of the company's capital components. Because those are the capital components, that which stakeholders might invest in, right? Now, that's not irrelevant. Here's where it's most relevant. So let's assume that Chris is choosing to look at a company and it has some cash on its balance sheet, but not a lot. It only has enough cash on the balance sheet to see to it that normal operations are able to be fluidly motivated, okay? In which case, if he were to acquire the asset, he wouldn't want to then turn around and raid that cash and use it to help him pay off some of the debt or offset some of the debt, etc., that he acquired, right? So sometimes when we think about enterprise value, we hold true to the equation market capital common, market capital preferred, market value of the debt minus cash, but a better iteration of that is market value of the common, market value of the preferred, market value of the debt minus excess cash. Because if you're not going to turn around and use some of the cash on the balance sheet, then maybe you shouldn't deduct it. In which case, that V is EV in that not rarefied, but specialized way of looking at it. Does that make sense? Good question. Please, Josue.
Just got a question before we get into more specific answers regarding the assignment. I didn't realize that I could have taken the assignment twice, so I'm kind of,
Yes. So how many of the rest of you didn't realize, maybe even until today, that you had 2 shots at that, 2 bites of the apple? It's about what I figured. A, pay attention. Because it said it in black and white on your computer screen every time you open the thing up. Okay. B, Josue has sent me an email. I am going to reopen homework number 1. And if you have not used your second attempt, I will give you through tomorrow night to use your second attempt. Even if you use the second attempt, and some of you have done so, even if you use the second attempt, it is still going to average your 2 attempts in the score that you get. Okay? But at least this will give you an opportunity for maybe a little bit of a redemptive opportunity. Okay? So thanks, Josue, for that. Please, Chris, and then Junyun.
So the cost of debt to capital, RD, it says it's equal to YTM if we have it.
Okay?
But a little further down in this sheet they gave us, the formula for YTM is current market yield divided by periods per year. So the market yield was 6%, that was given. And if you use the formula, you would get 3%. How do you know which one to
Okay.
use?
Good question. So think of RD and current yield, annualized number, as being the same thing. Current yield divided by the periods per year is YTM. YTM is somewhat of a specialized variable that we tend to use in the bond value calculation. We might generalize and say that current yield and YTM, yield to maturity, are the same thing, but only if you're using them in the same kind of time frames. So if you're thinking about this in an annualized number, which we virtually always think in annualized numbers, right? Then you wouldn't want to do that division. I understand why that might be a little confusing. What else? Please, Yun.
So, based on his question, the YTM 6% and the firm borrowed 10.2 million as a 6% rate as well.
Right, so the
Those-
current yield now is 6%.
Okay, so those 6% are like same thing.
They're the same thing. Now, if you were going to use YTM in the bond value equation, you would have to then go ahead and divide it by 2 periods a year, because bonds pay twice a year. But those would be the exact same thing in this scenario.
Okay. Oh, and by the way, are you gonna count our grade as using the average grade of those 2?
Yeah, in fact, yeah, so Canvas, if you use both attempts, I think Canvas is going to automatically average your scores.
Yeah.
Yeah. So, and let's return to something I talked about our first night as to why I would do that. When you turn in the problem sets, you pretty much get full points for them, regardless of the level of accuracy, because again, as we've talked about, there's really no reason to not have the right answers since you have the right answers available to you, right? But you get full points for that. So that means that I have to be somewhat more discriminating elsewhere in order to provide reasonable and realistic grades for you. So I let these quizzes be more discriminating, and I let the in-class problem sets be more generous. Fair enough? And no one has taken this class from me, done all the work, attended all the classes, and really honestly been able to say that they put in the time and gotten a grade that they weren't reasonably pleased with. Okay?
Even though Jameson tells us that,
Jameson told you that?
you're not gonna pass that
He would
class.
have said that it ruined his perfect 4.0.
Tell Jameson that in a master's program, we put on our big boy pants. Jameson's my friend. I think I've had 3 or 4 classes with Jameson now. I really like him. We got to travel together through the United Arab Emirates as well, so it was a lot of fun.
What was it, the word that he?
Bush League.
Bush League.
Bush League. Yeah, he told me something about one of my classes with Bush League. So ever since I've harassed him with the term. Okay, anything else about the problem set? Did anyone have a confusion as to how you dealt with the last couple of questions where you were told to, okay, so if you had confusions there, why are you not asking?
Because I met with a group, and we figured it out as a group.
Okay, so you had a confusion, but you're able to solve the confusion. Okay, and Hassan and I were talking about this a little bit earlier. I didn't do any real prep for you on that. I think I sent something out on Canvas or something, I can't remember exactly where, maybe it was in WhatsApp, and that may have been clarifying and may not have been. I hadn't done any prep for you on that because if you think about it and don't overthink it, it's actually really very simple. You buy 375,000 shares of stock for $10.2 million. You now have to think about what was the per share price. Well, it was $27.20. It wasn't the original $25. We've set a new market value for the stock, which means we take that new market value times the remaining shares outstanding after the purchase, and that's E. And what does D become? Well, D becomes the market value of the debt that you already calculated, plus $10.2 million. What is RD? It's the yield on that the bonds that were just purchased. And I believe RE changed a little bit because the change in leverage begat the potential for some greater volatility of the stock price.
It went up.
And so beta changed, and so RE changed through the CAPM equation. And now you're off to the races. So it actually was really very simple, and I left it there purposely because I wanted to see, could you think through it? Now, admittedly, I did go ahead and send out an explanation because a few people were asking me, but I kind of left it hanging. I want to know if you just were able to stop and think it through. A tremendous amount of this is simply stopping and thinking through. We want to go back and say, okay, what did he say about stock buybacks? We want to find our notes and we want to go back through and see what we should have memorized. But a lot of what we're going to do isn't about what you memorized. It might be about what you synthesized and have the ability to then think through. Okay? Any questions on the problem set? The first, questions 1 through 8, I think it was, of the using CAPM and WACC.
For 8, I had an Excel instead of writing it down. Do we need to submit that as well with it?
Did you also give me the answer on your...
No. I did
So
not
connect it to it and then give me a note saying, look at my sheet.
This is number 8.
Yep.
Okay.
Okay. All right. Well, in that case, let's move on. So last week, I think we talked about the basic construction of a valuation equation, right? And I began to articulate how we have an explicit period and we have a continuation period, and some of the simplest ways to look at those things. And I understand that simple might be in the eye of the beholder in this case, but my sense is if it's not simple to you today, now I know what it is. It's the smirk on your face. Okay? What may not be simple to you today, by the time we're done with our block together, almost certainly will be. Okay? I'd be really surprised if it's not. So let's just consider this. The value of an asset, we know, is the sum of, I will say, the free cash flows of the asset divided by 1 plus a discount rate. And here I've noted the discount rate as R, but the fact is the discount rate may be R as a generalized variable, or WACC as a particular form of a discount rate, or inflation, or interest, or hurdle rate, or investment return, whatever form of discount rate is appropriate to be used based upon the perspective you're looking at this from. Okay? Well, we have two problems with this. One of them is we know that the firm almost certainly, as a complex asset exists in perpetuity. And if we don't know that, what we know is that we don't know when it'll end, right? So we have to assume it exists in perpetuity. So the first problem we have with this is I don't know how to sum an infinite series of values. I'm done before I start, right? So I want to break this down into two segments. I want to say that it is equal to the sum of the free cash flows for periods I divided by 1 plus R to the T, when periods I equals some explicit forecast period. So some number of years that are finite where we think we can credibly forecast the free cash flows that we would expect to have from this asset. We're going to deal with forecasting later on. We're going to deal with it in minute detail, okay? But I think we would agree that if I tried to forecast what my firm or asset should be able to yield over the next year, I should be able to be relatively accurate in that forecast based upon the quality of the information I have. And I might even be relatively accurate in the second year, and in the third, less so in the fourth. I get out to the fifth, I'm starting to feel that limb kind of bounce underneath my weight, right? I try to forecast 17 years out, 18 years, 32 years out. I know one thing for absolute certainty. What is it, Walter?
This is unsustainable.
I'm wrong, right? So still, I can't do it. I even know about the first year I'm probably a little bit wrong, but I'm not terribly wrong. I'm just a little bit wrong. Okay? But if I try to forecast this out 12 years, I know that I'm badly wrong, right? Unless I've got some contracts in place that are lengthy contracts. But even then, shouldn't I be trying to get yet more business and such instead of resting on my laurels? So I just know I'm wrong, okay? So this I would be the number of years of an explicit period. So I might have 3 periods here that I have to sum up. I might have 5. Maybe I've got 7. I think I even give you something in the problem set tonight where it's like 13 or more. But recognize I'm stretching when I do that, okay? Plus, the free cash flow at time 1 divided by R minus G divided by 1 plus, R to the T. Now in this case, I have picked up what we refer to as the continuation term or terminal value and discounted it back to today, just as I've been discounting each of these values back to today. But let's talk about this terminal value for a minute, or continuation value, okay? You'll recall the equation. P0 is equal to D1 divided by R minus G. We've talked about that a few times, the dividend growth, dividend yield equation. And this is specific to common stock because D1 is the dividend coming from a common stock. R is our discount rate, and we know that R is unchanging. You have no reason to expect a change in the discount rate. If you are prescient enough to be able to identify the change in a discount rate, you need to be the chair of the Federal Reserve. Or have your next discussion from your private island in the Bahamas. Okay, because you are just that good. And because none of us are that good, I guess there's one of us at a time that's the president or the chair of the Fed, right? But none of us are that good right here, right now. If you start with a discount rate of X, then the whole thing needs to be done at a discount rate of X, right? And this G is the perpetual growth rate of this dividend. Because this equation actually is this equation. The sum of the DI's divided by 1 plus R to the T, in which we have every one of these D's, period 1, 2, 3, and into infinity, growing at a constant growth rate. So when we have this, and we know that this is going to go on in infinity, and we know that the cash flow variable will grow at a constant growth rate, we happen to be able to simplify the equation in this much simpler form that is able to take, is actually an approximation of an infinite series of values, but the summation of it, but it is so close as to nobody's going to argue. It's accurate out to like the 50th decimal point. Walter?
So when you use the dividend discount model, are you looking at a historical, this company raised their dividend 2% each year annualized?
That's a good question. First, this D1 means the dividend we expect to receive next. So it's not the historical, but you're really asking, how is it that we think we can use this G? So if it's a dividend, maybe the company has a track record of always increasing the dividend by 0.5% a year, okay? But that's not terribly satisfying. Remember, this is a dividend yield model. We're not simply trying to look at the value of a stock that pays a dividend because that's going to be partial at best for the asset. I'm just saying, here's the formation, and now we're going to morph it. This is the value at time 0. This is the free cash flow at time 1. Because value and price are synonymous to us, right? Free cash flow is a form of cash flow, just as dividend is a form of cash flow. Dividend is a very specified form of cash flow that is not a complete cash flow for the company. It's a discretionary cash flow that the board of directors may have elected to provide to the shareholders. So it's not satisfactory to value the whole asset. Okay? So we're going to use a continuation form like this for the free cash flow model, and in fact, while it won't be obvious to you, each of the model forms we use actually use this type of a continuation form. It's just that you need to be able to interpret them algebraically to necessarily see that, and I'll help you do that. But this is where we have a growing cash flow variable in perpetuity at this growth rate. What's the likelihood that in our explicit period we have a constant and smooth rate of growth? I don't think it's very likely, right? I think my company is going to yield a growth over the next 12 months of about 12%. And then I think, because I will have done some really interesting investments in marketing and R&D, that I should be able to see after that, and the next year I should be able to see a 22% growth rate. But then beyond that, I think that the economy might be softening a little bit. I might see us entering into a recession, so I'm going to pull that back to think about a 10%. We know that growth rates aren't constant, right? And we might be able to expressly forecast the next several years of them with our best and brightest minds, and I know I can't do that reasonably for perpetuity. So I express them as well as I can for a reasonable period of time, and then I take some generalizations and apply those generalizations to the rest of all time and perpetuity. And that's then expressed in this. But if I do this, and I use this value for a point in time after the explicit period, now I'm giving it a value at some point in the future, right? And because I give it a value at some point in the future, I have to discount that back to today. Does that make sense? Let me show it to you slightly differently. So the value of an asset is equal to the present value of the discounted cash flow plus the present value of the continuing value. Okay? Present value of the discounted cash flow during the explicit period, present value of the continuing value. Okay. Present value of the discounted cash flow is equal to the sum of those cash flows, and I'll just say those are free cash flows, I like that, divided by 1 plus, and now I'm going to say WACC, which is just one of the various versions of R, during our explicit period, whatever we have decided it to be. And the continuing value at time 0 is equal to the free cash flow at time 1 divided by R minus G, such that the present value of the continuing value is the continuing value divided by 1 plus R to the T. I would implore you to try to think of them in those relatively straightforward, in that relatively straightforward way. Now you might be thinking, oh, it's straightforward to you. But it is straightforward. It may just take you a little bit of time to digest it. Okay? So let's give an example, all right? Let's assume for a minute that we believe we have cash flow in time 1 of 100, in time 2 of 150, in time 3 of 2 1/4, in time 4 of 200, in time 5 of 300, and in time 6 and beyond, we believe that that our cash flows are going to grow at 3% a year. Because that's far enough out that we know we can't expressly, accurately forecast it, and we know if we put a big growth rate there, then the value of the asset's going to become the value of the known universe very quickly. Okay? So in this case, I'm going to say 3 and beyond is 300 times 1.03 to whatever our powers are as we utilize it. Okay? For each year. So, in which case, I now have to look at this. I'm going to come to this board. I now have to look at this and say, okay, what's the present value of my discounted cash flow? Well, it's going to equal 100 divided by, well, what's my discount rate? Let's say that my R in this scenario happens to be 10%. Okay? So what's the present value of my discounted cash flow? So it's 1.1 to the first, plus 150, I think it was, 1.1 to the second, plus 225, 1.1 to the third, plus 200, 1.1 to the fourth, plus 300, 1.1 to the fifth. So that would be the sum of the present value of the discounted cash flows during my explicit period. And I'm not going to sum that up right now. We'll get to it with our calculator in a few minutes. Does that make sense? I've expressly calculated my forecasted cash flows for 5 years, and I've then hinted at what I think they're going to continue to be beyond the 5th year. So then the present value of my continuing value will be the continuing value, which is going to be free cash flow time 1, but time 1 is not the same as this time 1. When is time 1 in this scenario?
Year 5.
Year 6.
It's actually year 6, so
Oh, sorry, yeah.
It's the year after, okay? Because we're always looking at the future cash flow. So it's going to be 300 times 1.03. What is 300 times 1.03? Is that 309? You guys have calculators, so give that to me if you would. Divided by 0.10 minus 0.03, which is the discount rate minus the growth rate we've applied. Is that 309?
Yeah.
Okay. And if somebody would calculate that, please, 309 divided by 0.07. That would be helpful to us for where we go next. 309 divided by 0.07.
4,414.28.
4,414.28.
Correct.
Thank you.
So what's 103 again?
1.03 is the cash flow we had at time, I'm going to call this 0, because it's the last year of our explicit period. And if the next year is 1, then this must be 0. So the cash flow at time 0, 300, times 1 plus the perpetual growth rate that we believe it's going to achieve. Okay? And if this was the if it was the 7th year, it would be times 1.03 squared. 8th year, 1.03 cubed, etc., etc. That's why I've given this infinite. Okay? So this number, 4,014.28, actually lives out here. Doesn't it? But is it in year 6 that it lives? Or does it live in year 5? Think of the equation. Value at time 0 equals free cash flow at time 1 divided by R minus G. So it's the value at time 0 for the continuation value, right? And if it's based upon year 1's cash flow, year 1 being the year after the explicit period, then time 0 would be the last year of the explicit period. So I literally would then add it to the 300 is I'm going to discount both of those numbers back to today from year 5. Does that make sense? Let's grab our calculators and do it. By the way, I know that silence means, I think I know what you're talking about. I know every word you're saying, I recognize every one of them, but I don't know that I know what you're talking about. Okay? When I was doing my doctoral program, I had a professor by the name of Katrina Rada. And Katrina was, well, she I think was 37 38 years old at the time, but she looked like she was 15. She's a very petite little Romanian woman, extraordinarily intelligent, but because of her diminutive size, looks rather young. And I came up to her one day after just a terribly challenging class that included far more calculus than I deserved to have to deal with that day. And I said, Katrina, I think I'm in trouble here. And she said, well, how's that? I said, well, I understood every word you said, and I don't have a clue as to what you're talking about. And she just smiled and walked away.
Ouch.
Yeah, it was that. She actually became the chair of my dissertation committee and is a very close friend even today. But she was just telling me, grow up. That's what she was doing. That was her way of doing it. Put me in my place in a big way. Okay, so let's do this. We're going to use the cash flow function, not the top line function of the calculator. Why can we not use the top line time value function on the calculator?
Because you can only add one of these values.
Yeah, we don't have a constant cash flow, do we, Josue? In fact, it's decidedly non-constant, okay? And it's not changing at a constant rate. So we can't do that, all right? Well, we do have a constant discount rate. We have a specified period of time. We do have a series of payments. We can do this. We can do this. So what's the first thing I want to do if I'm using the time value functions to do this?
Periods.
I want to set the periods per year, right? And so red C, and my calculator says I currently have it set at 2, so I want to change that. I change it by putting the number of periods I want. In this case, that's 1. Red PYR. PYR is the top line, second button from the right. So now it tells me if I do red clear, it tells me 1 period per year. Now I can go to work. All right? Pardon me?
Mine still says 2 PYR.
So do 1 red PYR. We good?
I pressed the wrong button.
Yeah, it happens to me all the time. By the way, some of you aren't used to this calculator. It sits in your pocket, and you sometimes will press buttons inadvertently, and all of a sudden, on your display, it's instead of having no words here, it says beg. Have you seen that show up yet? You will. It means beginning. Okay? Because sometimes we calculate interest from the beginning if we're doing discounted cash flow loans, and sometimes we do it from the end if we're doing traditional cash flow loans. Okay? If that happens, down here, let me find it real quick. Right here, second row, first button on the right, in the red it says BEG/end, beginning/end. It's a toggle switch. So if you happen to find it saying beg here, change that immediately. No bueno with the beg. Okay? So red, beginning end, it's a toggle switch. It'll get rid of that. Okay? Another one that's very common is you'll look at this sometimes and it'll have 0, 0, 0, 0, 0, which some of you recognize as European notation. 1,000 in European notation is seen as 1.000, comma 00. Okay? Just the opposite of the notation we use. We like it the other way around. That's more recognizable to us, right? It means the same thing. But if you see that that's happened on your calculator, once again, there's a toggle switch you've inadvertently touched as it's been in your pocket or backpack. And that toggle switch can be found last row, bottom row, button in the middle. It's activated by the red key. And you press the toggle switch, and it'll change that. Okay? So if you find there's the comma there, red, toggle it, back to a period. That happens all the time, and the first few times it happened to me, many years ago, it kind of freaked me out, didn't know what to do. All right, let's do this. If we are trying to identify the value of an asset, we're trying to identify its present value, which means we haven't identified a cost to net out against the present value, right? So in that case, we don't know any number that we should put in for time zero, because that number is what we're actually calculating, right? So in that case, we start at 0 CFJ, so 0 at time 0. 0 CFJ. And then we're going to say 100 CFJ, and it immediately tells you to put it in for time 1. 150 CFJ, puts it in for time 2. 225 CFJ for time 3. 200 CFJ for time 4. And then 300 plus 4414.28 equals CFJ for time 5. You can't put in 300 for time 5 and then put in 4,414.28 for time 5 again. Because when you press the button again, it believes it's time 6 now. So you have to sum those before you actually touch the CFJ button. And if you didn't do it, then you start it over. Please, Walter.
Maybe a simple question. Remind me what 1, 2, 3, 4, what these 100, 150, this is free
These are the cash flows coming off of this asset.
So this times 100 or 100,000, is that what we?
Well, not necessarily. I mean, the asset might be giving you $100. Yeah, you're thinking big, and I'm proud of you. Okay, but sometimes it's not warranted.
Sure.
I was actually with some business owners today, and one of them, sadly, for the cash flows for this year, had to think in these kinds of numbers. Yeah, please, to you.
So after we add the 4414.28, you click on CFJ again.
We click on equal first,
Oh, equal.
because whatever is on the screen when we click on CFJ is what it's going to accept.
Okay.
Okay, so sum those two numbers and then
And
click CFJ
Okay.
for period 5.
All right.
Okay, so now we've given it the time frame, because we've told it, every time we hit the button, we tell it another year. We've given it the payment schedule, non-constant though it may be. We have not given it a future value, because after this point in time, it believes there is nothing. Okay, a little bit of an anomaly, but it believes there is nothing, so we don't give it a future value. And we need to give it a discount rate, or an I divided by YR, interest per year. And we're going to do that at 10%, and it's not 0.1, it's 10. I divided by YR. And if it was 10.05%, it wouldn't be 10, it would be 10.05. Do not round decimals out. Keep maximum fidelity that you have available to you. Okay? So now, we've given it all 5 or 4 of the 5 variables. And we want to now calculate present value. We're not going to do that by pressing the PV key, because we're using the net present value cash flow function. So red NPV, which is the second row down, second button from the right. And it tells me that this is worth $3,447.72.15.
What is that X?
TVM.
Well, I understand what TVM is, but what does the X above the 2 stand for?
X above the 2.
Yeah, so,
I'm sorry, I'm not sure I understand what you're asking.
oh, so there's like,
XTVM over there.
I have no idea. I don't know that I've ever seen that, or if I have, I've never questioned it.
Do you have it in your calculator as well?
No, I don't. Yeah.
Do something wrong then.
Now, I happen to have grabbed the HP 10B2, not the HP 10B2 Plus when I was leaving my office, and my guess is it's got something to do with that, but we got the same number.
Yeah.
I just don't know what that notation means,
Okay.
David, I'm sorry. Okay. So this is the present value of the sum of the cash flows discounted for rate and time during the explicit period, plus the present value of the continuation value. So I've now gone ahead and I've supposed the perpetuity-based, forever infinite cash flows of this company and boiled it down to a number. Yippee. That's its value to me. If I paid this much for it, and then I got these cash flows exactly as expected, I would have received my 10% discount rate. And if that's my discount rate, if that's my requirement, then I'm a happy guy, right? Please.
Maybe I'm backtracking here, the 6 times 1.03, you're expecting what sounds like a 3% growth rate after that 6th year. into
The 6th year and beyond.
Right, okay, that's your guess, that's your.
That's my guess. You want to know where I came up with it? Off the top of my little head. Okay? Right?
So that-
Dangerous territory, right?
That could
Okay, it's
be-
all right.
That could be a negative if you think this might depreciate or lose money after this.
Well, that's a good point. If that number becomes a negative, then stop. Because there is no positive value to the asset. Stop. Recognize this 4,414 would have overcome this. Okay, well, that's what it'd have been a positive. If it was a negative, that's gonna be negative, this is done.
Yeah.
Okay? If you're forecasting, think back to Oswald the Motorin, if you're forecasting a negative cash flow, long-term for the asset, then somebody has to pay you to acquire the asset. It's not worth it, right? Okay, so just stop. You're all, it's done, you're all. Please.
So just to make it simple for my little head over here, if I were to buy an asset, and I'm projecting that this is the cash flow, net cash flow I'm gonna get from
Uh-huh.
the asset, and the 10% is what, basically the market price that I would love to make 10% profit.
That's your discount rate, and in this case, you're saying that's your hurdle rate you're requiring.
Exactly.
Okay.
So if I, supposedly the 3447.7, this is what I should pay for the asset. If
This
I
is its
acquire it.
present value.
Anything
That's
more
what-
than that, I would not be obtaining the 10%.
Yeah, so we're about to go there next,
Okay.
because that's important.
Okay.
Okay? So, let's just kind of let this stand for a second, and we're going to rerun our calculation. Only now, we're going to believe that we pay $3,447.72 for the asset. That's our cost, okay? And if we have a cost and a stream of benefits, we have a net present value, right? Let's do that. We're going to go ahead and clear all, so red clear, got rid of everything but the 1 period per year. And now we're going to start over, we're going to say 3447.72, which is the amount we're going to pay. Since we're paying it, it's going to be a negative, right? That which leaves me as negative, that which comes to me as positive under my convention. So I've got a toggle switch here, plus and minus directly above the blue key. So I turn that into a negative, and I type that into CFJ for times 0. Because that's how much I would pay today if I believe that's what I'm going to pay for the asset. Now let me put in these numbers. 100 CFJ time 1, 150 CFJ for time 2, 225 CFJ for time 3, 200 CFJ for time 4, 300 plus 4414.28 equals, which is 4,714.28 CFJ. And so now I've given it the cost and all the benefits, and now I'm going to ask it to discount those for rate and time. The time is the number of years I've input. The cost, the discount rate is 10, just like before. And now I can calculate a net present value, and it really is a net present value. And so red NPV. What's the net present value?
0.00151.
Does that surprise you?
No.
How many of you are surprised by that? Okay. Somebody that believes they understand it, tell me exactly why we have 15.15 here. Please.
I think it's because the amount of money that we're paying is offsetting the amount of money that we are receiving in the future.
Well, that is why it's so close to 0. Okay? Why do we have 0.15 there? Do you recall that this number actually was 72.15 until I erased it with my little hand? So we actually didn't pay quite as much as we calculated it was worth by 0.0015 cents. Okay? That's why this is so close to 0. So what does that tell us about net present value? When net present value is 0, or this may as well be 0, right? I mean, that's close enough. not even a penny. When net present value is 0, then the internal rate of return on the investment is the discount rate that we calculated. We got exactly what we thought we were going to get. When it's greater than 0, it means we got more than we thought we were going to get. This one was greater than 0 because we got 0.0015 pennies more in return in today's value than we expected, given our 10% rate. If it's less, then we got less than we expected. I introduced a term, internal rate of return. What's that mean? The rate of return that this string of cash flows over this period of time actually delivered to us. And in this case, it actually delivered to us 10%. Okay? So now, if we decide we want to calculate the internal rate of return, all we have to do is press red IRR, and the IRR key is directly to the left of the NPV key. Red IRR, and what's it tell you? 10. We got the 10% discount rate. Yippee. We like that. Any questions about that? Cool. It is cool. In fact, it almost seems like magic, doesn't it? Yeah, a little bit to me. Yeah. Even still. Sometimes I'll put in series of numbers, and I'm just amazed that they work out so well. Now, it probably means I don't understand, but I'm still amazed. Okay? So here's a question. If this had come back with a negative, negative net present value of, let's say, negative 150, and you decided to invest in this anyway, what would you be saying?
You're okay with giving up $150?
Very good. You're okay with getting a little bit less return over this period of time. Let's face it, it's a perpetuity, right? 150 grand over forever, not that much a year. Okay? So you're okay with a little bit less. But let's quantify what percentage rate you're saying you were okay with. So we're going to run the number again. By the way, we're doing this purposely because I know that for some of us it takes doing it 2 or 3 times before we embed it. Okay? We're just going to run it again. Only this time, let's, instead of paying $3,447, let's say we paid $3,600, which is about $150 more, right? So we think maybe it's going to give us a negative net present value, something like it. So I'm clearing it. I'm going ahead and putting 3,600, change that to a negative, CFJ for time 0. 100, CFJ for time 1, 150, CFJ for time 2, 225, CFJ for time 3, 200, CFJ for time 4, and then 300 plus 4414.28 equals CFJ for time 5. So my cost is 3,600, my benefits are my cash flows. I'm going to discount all those for rate and time at 10%, 10 I divided by YR. And now I know if I do net present value, red NPV, it actually gave me negative $152 and 27.8 or 27.85. So negative 152.2785. So about $150 less. Okay?
So what was the explanation again on that, the internal rate of return?
So I haven't done the internal rate of return yet.
Okay. Are we going to do that next?
Yeah, that's next. So now I recognize it's $152 less than I hope to get. What is it in terms of an annualized rate of return, the IRR? Okay. Red IRR, and it tells me it was 8.98%. So if I went ahead and purchased it anyway, I'd simply be saying that, yeah, I wanted 10%, but I would be willing to be satisfied with 9. Under what conditions would I be satisfied with 9%?
Inflation's only
3 or 4%?
I'm gonna have inflation either way, right? Might I be satisfied with 9% if I had no better options? I want 10, but if the best thing I see on my horizon is 9, 9's better than nothing, right? So I might choose that. Or maybe 10 is an aspirational number. Yeah, I really like 10. Actually, what I really like is 30. Okay? But I'd really like 10, but you know, if I can get 9, and if I think this is credible, if I think this is rock solid, non-risk oriented, would I accept 9%? That's what we're saying here. Inversely, and we're not going to run the number again. If I only paid 3,000, if I paid 3,000, what do I believe the net present value would be? You actually know the answer to this without calculating. Good for you. Or whatever, it was like 447, I think, or maybe it was 414, something like that, right? It's 3,000. It's this number plus this number was the original present value we calculated, right? So one of the calculations for net present value is present value minus what you paid for it. A little simpler, right? A lot simpler. But not always available to you. I'm going to show this stuff to you on Excel in a few minutes, or before we're done this evening. What questions would you have about the functioning of the calculator with this, or the concept of net present value at the moment? We'll talk more about IRR and then something called modified internal rate of return as well. Okay.
This isn't something that you, as part of the forecasting, is this what you do kind of after the fact as like a post analysis?
Yeah, so I've already forecast. I forecast the cash flows,
Okay,
right? And now I'm saying, if those are the forecasted cash flows, and I believe them,
yeah,
and 10% is my discount rate, what should I be willing to pay for this asset?
okay.
Now, I always want to pay less, right? So even if it came in at 3,447 or whatever it was, I might not offer that. I might offer 3,000 because I'm dealing with Manny. And Manny might know he'd accept 3,447. Are you going to ask for that, or are you going to ask for something a little bit higher? Come on, you're an old horse trader, right? You're selling used cars here. You can ask something higher because you know you're willing to come down. You know I'm probably willing to come up. It's the game we play. It's the game we play. But it's also a very interesting game because when he says I want 4,000, even though he might accept 3,447 in this case, what he's really saying is I want a greater return on this asset than you're thinking about. And when I'm thinking, and when I say I only want to pay 3,000, no, when I say I only want to pay 3,000, I want a greater return. When he says I want 4,000, he knows he's willing to accept a slightly lower return. Because if we put 4,000 in as our cost, our CFJ at times 0, cash flow at times 0, that's the price we pay for the thing, then this would have come out to a positive, or if we put it in at 4,000, it would come out to a nicely negative number. If we put it in at 3,000, it's going to come out to a nicely positive. Because we know the real present value is 3,447.
Seems like you could make a window on your discount rate saying, I'm comfortable with 8 to 12% back discount.
In fact, since you've said that, which means this falls under the heading of it's Walter's fault. Yeah. If we do a matrix of values in which we have two different valuation model forms, we might think of the free cash flow model, we might think of the key value driver model, okay? And maybe we like the 10% rate, but maybe we know that 8 and 12% is viable. We might come up with a matrix of values. We might want to hang our hat on this one right here, but we know in our heart of hearts that this is our negotiating space, right? We'll talk more about that at the very end of the term. tell me what internal rate of return means, and if you know how it's calculated, tell me how it's calculated. What's internal rate of return mean?
The percent you expect.
No, it's not this percent we expect.
The one you actually
It's
got.
it's what we actually got. It's what we actually experienced, which might be different than what we expected, as we just showed, right? It's what we actually got. And you know, you've probably heard that term many, many times. Easy to calculate on your calculator. It's actually easy to calculate in Excel. However, it's not very accurate. There's a problem with it. Any of you know what that problem is? Is there an equation for internal rate of return? A singular equation that doesn't involve calculus, just algebraic? There's not. There's not. I'll give you lots of other equations. You know, I like that. Okay. There's not for that one. It is calculated by extrapolation. We guess this, we come close, we guess that, see what it does different, we hone in on it until it gets us something to within a margin of error with extended decimal points that we can live with. Okay? So that's one problem. Another problem is that when we have an internal rate of return, that the internal extrapolation process assumes that any surplus cash flows are being reinvested at this amalgamated rate that we're coming up with. Well, that might be okay when the internal rate of return is close to your discount rate, which is your opportunity cost of capital. Because you should be able to get your opportunity cost of capital, right? But what would happen in this scenario if we paid $3,000 for the asset, it had a $1,000 cash flow for each of 5 years, and then this 414. And what would happen then? So let's play that game for a second. So I'm going to change each one of these to $1,000. And first, let's calculate what the present value would be. I didn't change the 4,414. Well, I guess I do have to change that. Darn. Excuse me, let me get my eraser. I need to figure out a new continuing value. So this is going to be 1,030, which is $1,000 in year 5 times 1.03 to get to year 6, right? Divided by 0.07, which was 10% R minus 3% G. And so what is that number? 1030 divided by 0.07. So it's 14,714.26 this time. Pardon me?
28.
Oh, maybe I did it wrong.
2.29.
29. Thank you. Like that, part of a penny or two is going to make a big difference. Thank you very much. No, I appreciate when you're accurate. So that's our continuing value, not yet discounted for rate and time, right? Back to today. That number lives in the future. So we're going to say plus 1,000 divided by 1.1 to the 5th. And that 1,000 is going to have added to it 14,714.29. So that's our cash flow now, right? So let's go ahead and think about this. Clear this out. And now we're going to run a present value, which means 0 at time 0. When we're doing a present value, it's always 0 at time 0 because we don't have a cost yet. We're trying to figure out what one reasonably would be. 0 at time 0. 1,000 for time 1, and if your cash flow variable is not changing, you don't need to keep putting in the 1,000. Press the CFJ key again for time 2, again for time 3, again for time 4. Don't press it for time 5 yet, because you have to add these two numbers, which is going to be 15,714.29 for time 5. Okay? And so now we're going to give it a 10% rate. And we're going to calculate the present value, red NPV. And the present value is equal to 12,927.20.
I got
What if,
13,000.
pardon me? Pardon me?
I got 13,927. Did I add another CFJ?
You put a 0 on the first one?
Yeah.
Did anybody else get my number?
Yeah.
Okay, all right. Okay, so you just got an input just slightly off.
Or you're all wrong.
I could have said that you were wrong, but I'm trying to make up for having called you Hassan a few minutes ago when your name is Mazen. Right? My bad, I'm sorry. Didn't mean to. Okay. So that's our present value. What if we actually have the good fortune to only pay $3,000 for this? So we have a cost of $3,000. Okay? Which, by the way, when we put it in for time 0, is actually $3,000 divided by 1.1 to the 0. Right? Why is it 1.1 to the 0? Because it's to the time 0 right now. What is any number to the exponent of 0? 1. So we just say it's $3,000. We don't have to get all highfalutin that. Okay? So let's go ahead and put in this stream. Let's say that this is our cost. And so we're going to clear it, clear all, red C, and say 3,000 change. So that's giving us a negative 3,000. CFJ for time 0, 1,000, CFJ for time 1, 2, 3, 4, 15,714.29 times 5. So we've given it all of our costs and benefits as we experience them, or expect to experience them, 10% expected return, and now let's go ahead and calculate the NPV, which I think we can figure out what that should be. I'm gonna suggest that it's $9,927.27. Let's see if I'm right. Red NPV, darn, $9,927.20. Because net present value is the same thing as present value minus what we paid for it. Okay? Present value of the benefits minus the present value of the cost. What happens if your cost is spread out over more than 1 year? What if I pay $5,000 today and agree to pay $5,000 a year from now?
You net it?
I would net my time 1 benefit with that $5,000.
That doesn't seem like it accounts for interest or the future value of those particular dollars.
It actually does, because when we put out that additional $5,000 as a cost in time 1, we're actually considering a discount rate of 10% against it, or maybe an interest rate.
So
it
you're
actually does.
discounting the payment as well as the cash flow.
It's discounting both. Yeah, but if I say I'll pay you $5,000 today and I'll pay you $5,000 in a year, if I pay you $5,000 in a year, it's not worth $5,000 today, but it is what I said I would pay, right? And you're right, it's not worth $5,000 today if we pay it a year from now. That's a good point. Okay, so this is our net present value. What's our internal rate of return?
58.64.
Shazam! How'd you find it? How'd you get that number? You're right.
Well, the red fee,
Yeah.
IRR.
Red, IRR. And it says internal rate of return is equal to 58.64%. Here's the problem with internal rate of return. Tavita, if your discount rate is 10%, does it mean that you reasonably think you can make 10% on investments in the market?
Yeah.
Yes, it does. That's your opportunity cost. I'm loading you here, brother. That's your opportunity cost of capital. If it's your opportunity cost, it better be realistic, or you're simply wrong, right? If you say my opportunity cost of capital is 78%, and you don't normally receive 78% on investments, then you are up in the night. Okay? So your opportunity cost has to be realistic. Remember when we were talking about opportunity cost of an investor's time? It needs to be what they have been paid in the past. If it is some highfalutin number, they're up in the night. They're dreaming. Don't dream on opportunity cost, please.
Quick question, when you mentioned that the scenario where you're gonna pay some money right now and like 5,000 in 2
Uh-huh.
years, would it mathematically work if I change the third year 1,000 to be minus 1,000 minus whatever I'm gonna pay? So let's say I'm gonna pay 5,000, but I have a cash flow of 1,000, so it'll be minus 4,000, and I calculate the CFJ that way?
Well, what you would do in this case, and I think the answer is yes. I just want to parrot it back to you. In this case, if we were willing to pay 10,000 for this, 5,000 now, 5,000 in the future, our CFJ at time 0 would have been 5,000. Our CFJ at time 1, if we're paying it in 1 year, would be 1,000 minus 5,000, so the minus 4. But our CFJ in time 2 would still be 1,000.
So I just plug it that way and...
Yeah, right. Exact same thing. Good. So think about this. I said one of the problems with internal rate of return is that internal rate of return, as it's extrapolating this number, trying to figure out what it should be, the calculation supposes that all excess cash flows are reinvested at this amalgamating number. Tavita and I have agreed that 10% is reasonable. Tavita, is 60% a number that you can reasonably expect to get on investments in the market? No, I don't think it is. Oh, you might get it once in a lifetime, maybe now and then if you're very fortunate, but you're not going to expect it to repeat, right? But the IRR equation is acting as though it's repeatable. So the modified internal rate of return steps in to adjust for that. And modified internal rate of return assumes that excess cash flows are being reinvested at the discount rate, not at the amalgamated rate. I'll show you how to do that in Excel in a few minutes. I don't know how to do modified internal rate of return on the calculator. I don't believe you can. I don't think it has a function for it. There is an equation for it. You're welcome to look at that equation. It's in my notes online for you. You got it in 2 or 3 places there. I'm not going to hold you responsible for it. It is not the simplest of equations. It's actually simpler than you think it is, but it doesn't look that way to begin with. I want you to understand it conceptually. The modified internal rate of return supposes that all these cash flows we're getting are able to be reinvested at our discount rate. And we apply a discount rate that we believe is reasonable, it's realistic. Otherwise, it shouldn't be our discount rate. Whereas internal rate of return supposes that we calculate or reinvest all these flows at the amalgamated rate that's coming about for the internal rate of return. Now, if the IRR and the discount rate are very similar, it doesn't make any difference. But if the IRR and the discount rate are very different, then it makes a big difference. Okay? That said, almost no one uses modified internal rate of return, except for those that are just way geeky into this thing. Love it. And how many times have you heard financiers talk about IRR, your internal rate of return? They're using a flawed measure. If the IRR is 3%, it assumes that these cash flows are reinvestable at 3%, which is less than realistic, right?
Yeah.
Yeah.
So will the modified internal rate of return be 10% discount rate that we look at?
Well, the modified internal rate of return is going to give you another number. I'm going to show that to you in a few minutes when we go to Excel.
So
Okay?
this example is just to show just kind of the other side of
Exactly.
IRRs. Okay.
I haven't given you the MIRR number yet because I don't have the ability to calculate it here. I have to go to Excel to do it.
Yeah,
Or I could do it manually, but I just don't want to.
Yeah, because when we did that net present value, then I jumped ahead and I did the IRR. And it came out as 58.64.
Uh-huh.
I thought I did something wrong. I just
No,
gave up.
you got it.
Okay.
That's the number it gave you. I'm just saying it's not realistic for that to be a reinvestable number. Oh, it might be accurate under a flawed methodology, but it's a flawed methodology that believes you can reinvest at whatever the discount or whatever this amalgamated number is, and that may not be realistic. So we use the MIRR equation, which you're not going to have to do, but I'll show you on the Excel. Okay, all of that and the dollar, and you can fill up your soda at the gas station. Right? You can refill your soda at the gas station. Without the dollar, you're still screwed. How do you feel about that? Come on, guys, lighten up a little bit. All right, It's been a longer day for me than it has for many of you. Okay, so we want to look also at payback, and we want to look at profit index. But I want to do that from within the context of Excel.